Welcome to The Explainer, everyone. Okay, so today we're tackling what is honestly a pretty dense, data-heavy document, the May 2026 Monthly Fund Review. And our goal is to translate all of that into a really clear journey. We're going to track this fascinating narrative that starts way up high with these massive global macro events and watch how it ripples all the way down to your local investment portfolio. If you've been watching the markets lately and thinking, how do all these moving parts actually connect? Well, you are in the exact right place.
So let's take a quick look at our agenda. We're covering 6 key areas today: the global tech rally, Asia and ASEAN market shifts, the Malaysian market landscape, economic headwinds and tailwinds, a spotlight on domestic funds, and finally, navigating the road ahead. Let's dive right in.
To get things started, we really have to ask the big question that was dominating pretty much every single investor's mind in May of 2026. Global markets were hitting these absolutely fresh highs, completely defying a lot of the baseline expectations out there. But what was actually fueling the engine?
Section 1. The Global Tech Rally.
The sheer scale of this rally is just wild. Think about it, the tech-heavy NASDAQ was up 31.5% over 1 year, which, let's be real, is phenomenal, and its year-to-date numbers of 13.4% are really strong as well. But then you look over at the Korea Composite. They're sitting on a staggering 169% one-year return. With an 88.6% year-to-date return, it makes the U.S. market look almost sleepy by comparison. So we're definitely looking at a massive global phenomenon here, not just a localized American one.
You know, the crucial thing to understand is that this massive growth wasn't just some random fluke. The S&P 500 hit fresh highs for the second consecutive month because the underlying fundamentals were actually delivering the goods. This was a highly concentrated rally fueled directly by incredibly strong first quarter 2026 corporate earnings across the tech sector. And sitting right at the absolute center of that earnings explosion, that would be the insatiable, robust global demand for artificial intelligence applications. AI is essentially acting like a giant gravitational pull for the entire global market right now. Moving right along to Section 2, Asia and ASEAN market shifts.
It's really like a tale of two markets here, and the contrast is absolutely fascinating. On one hand, you've got South Korea and Taiwan hitting all-time highs. Why? Because you simply can't have an AI boom without their advanced semiconductor chips. They are quite literally the global factories for high-performance computing. But then on the other hand, China, which is obviously a massive regional anchor, faced some pretty serious headwinds. Their domestic retail sales slowed way down to a 3-year low of just 0.2% year-on-year in April of 2026. So you've got this white-hot AI-driven boom in one part of Asia and really fragile consumer confidence in another.
Meanwhile, down in the ASEAN region, things were a bit of a mixed bag, to the point where it required some immediate defensive action. The perfect example of this is Bank Indonesia. They were actually forced to step in and hike their policy interest rate by 50 basis points, so 0.5%, bringing it to 5.25%. And this wasn't about trying to cool down an overheated domestic economy. This was specifically targeted to stabilize their currency, the rupiah, right in the middle of these shifting global capital flows.
Which brings us to Section 3, the Malaysian market landscape.
Let's focus on this massive number for a second, 36.9%. That represents the surge in Malaysia's exports year-on-year in April 2026. It is a spectacularly big figure. And honestly, if you trace it back to what we just talked about, the driver makes total sense. It was an acceleration in exports of electrical and electronic goods, E&E, along with petroleum. Basically, Malaysia is just deeply plugged into that booming global tech supply chain.
And honestly, even more impressively for local investors, the domestic Malaysian technology sector rallied by a fantastic 19.0% in May alone. This right here is that macro ripple directly hitting your portfolio. The local tech sector was moving in complete lockstep with those regional semiconductor-related stocks we saw exploding over in Taiwan and South Korea. Now here's where it gets a little nuanced, right? And this is exactly why looking at the data structurally is just so important. Because despite some incredibly strong macro indicators, Malaysia's first quarter real GDP growth was actually revised upward to 5.4% year-on-year. Backed by 7.3% growth in private investments, the overall Malaysian stock market index, the FBM KLCI, actually eased slightly. It dropped 2.3% in May. Why did that happen? Really, it comes down to two main things. Foreign funds were flowing out and local investors were actively taking their profits, especially across the consumer and commodity sectors. So the underlying economy was humming, but basic market mechanics led to a slight dip in the index.
Section 4,
economic headwinds and tailwinds.
So if we trace this timeline, it becomes a lot easier to understand the overall mood of the market. Back in April, the U.S. Consumer Price Index, which is obviously the key measure of inflation, ticked up to 3.8%, and that was driven pretty heavily by energy prices. Then in May, we saw this sudden shift as Brent crude oil dropped 19%. But here's the catch. That sticky inflation data from April was already enough to fundamentally change investors' psychology. Market expectations rapidly shifted. People had been hoping for U.S. rate cuts. Suddenly, the data was pointing toward a potential U.S. policy rate hike by late 2026. And that expectation of higher for longer interest rates, that is a massive headwind for global equities.
As impartial observers of the data, we also have to look closely at what actually caused that May oil price drop down to $92 a barrel, which gave us that brief economic tailwind. The source data explicitly links that 19% decline directly to the extension of a ceasefire during U.S. and Iran peace negotiations. It's incredibly clear here how geopolitical negotiations don't just sit in the background on the news pages, they act as a direct, measurable economic variable that influences inflation and ultimately the interest rates that affect us all.
Moving to Section 5, Spotlight on Domestic Funds. Let's pull directly from the source material for a second. This is the fact sheet for the Public Aggressive Growth Fund, or PGAF. This is a fund explicitly designed for situational and high-growth stock investments over the medium to long term. Let's look under the hood together, almost like we're exploring a blueprint to see exactly how a local fund manager navigates those massive macro currents we were just talking about.
Now, this breakdown is actually pretty surprising. When you hear the words aggressive growth, you'd probably expect a portfolio stuffed entirely with highly volatile tech stocks, right? But look at how heavily they're weighting reliable financials, 32.6% of the fund. They're using that to anchor the portfolio against the exact volatility we've been discussing. At the same time, though, they maintain a very strategic 7.7% exposure to technology just to make sure they capture that upside growth. It's a really calculated balance.
And when you really dig into the specific holdings, the whole strategy just kind of clicks into place. You have domestic stalwarts like Public Bank and Tanaga Nasional providing that rock-solid stability. But the absolutely crucial point here is that right alongside them, sitting comfortably in the top 5 holdings, is NVIDIA Corporation. By holding NVIDIA, this domestic Malaysian fund directly connects its local investors to that massive global AI rally we highlighted at the start of the explainer. And remarkably, they pull all this off while keeping a volatility factor of just 8.0. That means the fund successfully avoids wild price swings, actually earning a low classification from Lipper. It's really a fascinating structural design.
Finally, Section 6, Navigating the Road Ahead.
So what are the key takeaways from the review's outlook? Well, they're actually pretty straightforward. Because of these evolving global headwinds, like U.S. interest rate expectations and those Middle East negotiations, you should absolutely expect some near-term volatility. It's a given. Therefore, adopting and maintaining a long-term investment horizon is totally critical right now. More practically, the data strongly suggests practicing ringgit cost averaging. By investing a fixed amount regularly, you actually benefit from these market fluctuations rather than getting stressed out by them. Moving forward, your critical metrics to watch are global oil prices, the ongoing shifts in international supply chains, and of course, watching to see if those massive corporate AI capital investments continue to actually yield earnings growth.
And that pretty much wraps up our explainer for today. But before we go, I want to leave you with this final thought to ponder. As you look at your own portfolio through the lens of this macro ripple effect, how are you positioning yourself to handle the headwinds of inflation while still capturing the undeniable tailwinds of this global AI boom? Thanks so much for exploring this data with me today, and keep learning.